Fed raises interest rates, or they choose to hold the last meeting. Yeah, they choose to hold, but they say we're going to, or they alluded to, going to raise rates at least one more time. And then we see the stock market tank. Hey, it's Kevin Amolsch, Pine Financial Group, where we work together so you succeed. Look, you found us. You found us here on Facebook. You found us here on YouTube. Please help me out. We're trying to build a following, a channel, so we could help more real estate investors just like you. You could help by hitting subscribe, hitting like, and leaving us some comments below. I got a fantastic video for you today. Our good friend Joseph Massey is here. You probably don't like it when I call you Joseph, do you?
I love it. You're always welcome to call me that.
Joe Massey, Castle and Cook, we want to talk about interest rates because that seems to be a hot topic, especially with as high as they are and the fear that the Fed is going to keep rates high. What is that going to do? So we're going to get into the details here about what's going on with interest rates. So Joe, quickly, man, tell us who you are and why you're qualified to be on this call.
Yeah, so my name is Joe Massey. I'm with Castle and Cook Mortgage, and I've been in the mortgage business 21 years now and have worked with Kevin and the team at Pine for, more than a decade. And so my job is to help investors with their long-term permanent financing. So Kevin helps you with your fix and flips, your short-term financing, your commercial loans, and everything I do is what you decide you're going to keep in your portfolio for the long term. I come in and work with Kevin and his team to give you a 30-year fixed rate loan, make sure that property is going to cash flow, and make sure you're going to be in a good position with that property for the next 5, 10, 20, 30 years.
Perfect. So we're going to talk interest rates. You talk to your clients every single day about this. Yeah. And I know that there's a lot of concern. So let me paint the picture for you here, Joe. You saw it play out. Fed raises interest rates, or they choose to hold the last meeting. Yeah, they choose to hold, but they say we're going to, or they alluded to, going to raise rates at least one more time. And then we see the stock market tank because they had built in no raises, but they did not build into the pricing the possibility of further increases, which is bizarre to me because of the sticky inflation and the strong jobs numbers. But it is what it is. So now, what does all of this mean? What does all this mean?
Yeah, that's such a great question, and one other thing I'll throw in there that doesn't show up on the Federal Reserve is nervousness about a government shutdown. That causes people to be nervous, causes money to come out of the stock market, flow into the bond market, which can increase bond prices because people want a better return. What does that do? Increase interest rates. So there's a lot of different things that are moving. In the short term, we'll talk about the Fed funds rate. That is just the short-term rate that banks are charged to borrow money back and forth. That is not directly correlated to long-term 30-year fixed rates or 15-year fixed rates, but it is an indication of what's happening with interest rates and what's going to happen with the economy in the next 3, 6, 10, 12 months. And the federal funds or the Federal Reserve saying, hey, we're probably going to increase the short-term rate again, trickles down to long-term interest rates are going to continue to go up. And we're seeing that. Right now, the Freddie Mac 30-year average is 7.31 as of last week on Thursday when that survey came out. However, the daily survey from Mortgage News Daily actually has that average 30-year fixed rate at 7.6 as of today for a primary resident buyer. Now, that doesn't mean...
And we are recording this for the listener. We are recording this on 10/2. It's a Monday. So there's going to be a little bit of a gap here, about a week lag.
Yep. And so, does that mean that you actually qualify for 7.6? No, maybe you qualify for something better if you have better credit, or maybe you're buying an investment property and you're putting a large amount of money down. You might have, a little bit of a higher rate, or maybe you're putting really low money down. You might have an even higher interest rate. So there's a lot of variables that go into it for what is your individual interest rate for folks that are listening.
So I put out a newsletter a while back and I said, there's not a big correlation between the short-term and the long-term rates. And I got some pushback. They were like, no correlation. That's insane. And you're right. I agree with you. Over time, higher short-term will drive up mortgage rates and long-term rates, but it's not correlated.
It's not direct.
If you look at the graph, it's very strange. But what is directly correlated, as you alluded, with the bonds, right? The treasuries, and it's more specifically the 10-year. So tell us what the 10-year is and why does that correlate to mortgage rates?
Yeah, so the 10-year treasury yield is a 10-year bond that is going to be repaid by the U.S. government. And that yield right now is right around 4.6. And then on top of that yield, you add a margin or spread, and that gives you a good idea of where 30-year fixed interest rates are at. And that spread right now is about 3%.
Yeah,
so you take
high.
4.6 plus 3. What are average 30-year fixed rates? Right at 7.6%. And so mortgage-backed securities are closely correlated with that 10-year treasury. And as you see that 10-year treasury going up, you'll see mortgage-backed securities and mortgage interest rates going up as well. But, that 3% spread above that 10-year treasury.
And on the average, we've talked about this a lot on this channel and other channels. The average is about 1.7 is that spread. And right now it's at 3. So it's almost doubled what the average spread. So we would think that over time that spread would go back down towards the average, which that would either mean the bonds going up or mortgage rates coming down. I think that's what we all are expecting. Maybe not immediately, but over some time here. So what do you think is going to happen?
Well, I think you're exactly right. Eventually, part of the reason that spread is so high is a lot of people think that interest rates are going to decrease in the future. So let's just say, for example, you, Kevin, are issuing a mortgage-backed security of $100 million, all right? And you think that interest rates are going to go down sometime in the next 6, 12, 18 months. Well, you've got to guarantee a certain return to your investors, but those loans might pay off if rates go down in the future. So how can you offset that risk of those loans paying off? By charging a little bit of a higher margin right now so that your investors make more money in the short term. And then when those loans pay off, it'll be a more normal spread of 1.5, 1.7, 1.9%, just as like you alluded to. So as rates go up really fast, margins go up. Hopefully rates will improve in the future, margins come down, and everybody has an opportunity to refinance.
Necessarily want to make you pull out your crystal ball here, but I got to ask, because as of, I guess it was Saturday night, the government decided not to shut down, and they passed the bill, and all that did was kick the can down 45 days. So mid-November, we're going to be up against this again. So what do you think, assuming it goes like we all expect with the very last minute, what do you think mortgage rates are going to do?
I think they're going to continue to trickle up. I mean, I hate to be Chicken Little that the sky is falling and interest rates are going through the roof, but it would not surprise me if 45 days from now, you and I are having this conversation and we're talking about average interest rates of 8%. Now, if you would go back and look at this from a year ago, I thought that we would cap out right around 6.5 to 7%. So I have been wrong before, and I guarantee I will be wrong again at some point in the future. Maybe this is the one where I'll be wrong. Maybe it'll be a future episode. But I do think that an 8% interest rate could be very realistic for a primary resident buyer sometime in the next 30 to 60 days.
Okay. And there's a lot of economists out there that would disagree. I don't really know. I have no freaking idea.
Exactly.
But like some of the big ones, Fannie Mae, for example, I think they're expecting mid 6s at the end of the year. So they're still thinking it's going to come down, but who knows? This government shutdown is going to change everything, right?
And I think that's the thing, is there's so many uncertainties and so many variables. I do actually have a degree in economics. I don't know if your listeners know that, but there's only a certain number of variables that you can plug into any economic model. But how many variables drive interest rates? Nearly infinite, right? We could talk about your individual credit score, your individual down payment, your individual property type. So there's individual variables you can control, but then there's so many other variables, from the Federal Reserve, China, the war in Ukraine, the federal funds rate, federal government shutting down. There's so many variables that impact it. There's no way to really know. And I think the folks at Fannie Mae and National Association of Realtors, I think they're really smart, but I actually went back and looked at their projections from a year ago of where we would be at today, and they projected interest rates of 4.5 to 5.5.
Yeah, I keep seeing that. They keep going up, don't they? Their projections just keep creeping up. Yeah.
So not that they're wrong, not that they're right. Nobody knows. If anybody knew, they certainly wouldn't tell me and you. But I think the last thing I'll add is I still think it's a really good time to buy property. Because I do think that 8% is kind of unprecedented for the last 20 years. And if you buy a property today at 8% and rates go up, hey, you know what? You look like a genius because you bought right now and you negotiated the price and rates continue to go up, you're locked in. If rates go down, we have our free refinance program that anybody
ask you about that.
Yeah, we have our free refinance program that anybody that closes with us this year gets a voucher in their closing package that they can refinance in the future whenever interest rates go down, and there will be no lender fees or admin fees or title fees. So we kind of take a lot of the risk out of it for an investor buyer or primary resident buyer, that if rates go up, congratulations, you got a great deal. If rates go down, congratulations, you call me and we'll give you a free refinance. We
That's
take a lot of the
huge.
risk out of it.
That's huge. And we love you. So we send all of our clients to you. So if you're listening in, or if you're watching the video, take advantage of this. What states are you licensed in?
So myself personally, I am in Colorado, Wyoming, Nebraska, New Mexico, and for an oddball reason, Georgia, which I actually do some transactions in Georgia for some of our investor clients. But then as a company, we're licensed in 44 different states. We've got offices in more than 30 different states. So we can help you just about anywhere in the US. There's a handful of states that we're not licensed in, but just about anywhere that you are listening to this, give me a call. We'd love to chat.
All right, man. Well, I'm going to let you go. Appreciate you helping us, jumping on this call, explaining the interest rates, unpackaging this for us. I know it's confusing to a lot of people when they see, the short-term rate go up and mortgage rates go down, but that's because there's not a ton of correlation there. It's definitely the 10-year like we talked about. If you're interested in financing a property or refinancing, get a hold of Joe. How do we do that, Joe?
Yeah, you can call me. My phone number is 303-809-7769, or you can email me. My first initial J, last name Massey, JMASSEY at castlecookmortgage.com, or just put a comment down below. We would love your opinions. And if you disagree, we'd love to hear that too. That's some of our best conversations, is when folks maybe have a different point of view that Kevin and I haven't thought about. So put a comment down below. Be sure to like, subscribe, share with your friends, and let us know how we can help you.
Love it, man. And if you need any help with your hard money lending needs or fix and flip funding, check us out, pinefinancialgroup.com.
Thanks, Kevin.